Hello, my name is Jingo Nelly, and today we are going to be looking at another tutorial. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams.
Credit purchases, etc., and suppliers. So that's some of the information we need to have as we audit these payables. Maybe also you need information about the accrued expenses, etc. So that's some of the information you need when you are preparing to audit payables. So how do we do it? The tests, we have analytic measures, we shall have questions, we shall have external confirmations, we shall have inspection of documents. Those documents are listed there. We shall have inquiries, any other. We can have recomputations. etc. So who can develop for us the first test using analytical? What do we compare? We are starting with analytical. Somebody develop for us the test.
Compare trade payable balances with those of a previous year.
Stop there and investigate any.
You compare the current balances with the previous balances.
Can you say compare opening balances and the closing balances?
You complete the test and investigate.
We compare opening balances and closing balances to investigate completeness.
To investigate whether there are increases or decreases in the balances.
Apart from opening and closing balances, what else do you compare?
Compare balances, trade balance and ledger, and agree them with those in the financial position.
That one is an inspection. You agree, you just agree those ones. You don't compare, but you agree. I said you compare opening and closing balances. I said you compare the ratios. Which ratio is here? There's the payment period ratio, this one. I also said that you compare. You people are not getting these things, yet I've been repeating them. I said the first thing you compare is the opening and closing balances. That is for assets, liabilities, and equity. For sales, there's no opening and closing balance and expenses. I said after that you also compare the ratio, if there's any ratio. I said you also compare per product if it is possible. I said you also compare with the budgeted figures. I said you also compare with, we looked at all these things. I said you also compare with if there are branches, for example, products, yeah. Then from there, we go to recalculation. What do we recalculate on data on payables? What do we recalculate?
We calculate the purchases invoices. To test for accuracy.
Then what else?
Pairing is analytical.
Then external confirmation, do we write to the payables or we don't write to them?
We
So to confirm what are we confirming when we write to them, when we obtain confirmation?
Yes, you obtain the written data.
And what are we auditing when we obtain them? Which assertion are we trying to verify?
Existence.
Existence.
But also the closing balances, whether the closing balance is correct or not. We can also recompute the discounts, as somebody is saying. Inspection, this is where most of the tests are. So which documents do we agree? Or do we match? Or do we review?
You said that some purchase orders agree with the goods received notes and invoices to test for completeness.
You can also agree the confirmation letters, confirmation from, I listed all these documents here, from payables or from creditors. So you can agree to the balance in the payables account. For GL and statement of financial what? Position for test for completeness. You get it like that. You can also agree or check whether all invoices, all GRNs and invoices, goods received notes and invoices are posted to the purchases, the payables ledger, all that. Then you can reverse these tests for existence and occurrence. You can do inquiries and all that. So these are the tests which you have brainstormed on. I said that you get the list of trade payables, the list. So that list, cast it and agree to the total general ledger and statement of financial position. You're moving forward. So this list of payables, does it match with the general ledger and the balance sheet? Remember this list, I said it comes from invoices, it comes from the individual ledgers. The difference between payables ledger and general ledger is payables ledger, that is for each person, for each data. So from each creditor, from each creditor's account to get a balance, you list them, all those who still have pending balances. Compare the list to the general ledger, should be matching, and then balance sheet. And then compare. So this is inspection. This test here is an inspection test. When you see the word agree, this is inspection. Inspection. Then the next one is, you see compare, it is an analytical. I already talked about that. You compare the total trade balances, trade payables balances, current and previous year. Find out, are payables increasing or decreasing? I talked about the days, compare the payables days. How many days are we taking to pay the payables? Are those days increasing or decreasing? I talked about matching the review after date invoices and credit notes to ensure further items need to be accrued. So this is like items you have returned. This is for returns outwards. When you return goods out, maybe they were excess, they issue us a credit note. Now, that credit note is supposed to come and adjust our invoice down on their demanding us. If you return goods of 1 million, then they should come and remove 1 million from your balance. You get it. The other creditors, but also you also remove it from your account. Because remember here you debit, it turns outwards, and you credit creditors. So we should be seeing that reduction in creditors. Like that. But for after date invoices, these invoices come after the year end. We must confirm whether goods were delivered before year end. They will be goods for the current period. Then we must also look at the suppliers as auditors. We must check whether this business paid some suppliers right after year end. They might have paid, but they haven't adjusted the account. So you must look at why is the data still much? Did they pay some of them after year end and they haven't just gone back to adjust the ledgers or not? Like that. Then you get GRNs and before year end and confirm they are included in their end payables. Whenever we receive goods before year end, we must include them. Those goods, even if we haven't paid for them, they are for the current year, they should be included. So as an auditor, you get a sample of these GRNs right after before year end, sorry, and check that has been included in the payables. Those goods have already purchased them on credit. Then inquire from management the process of identifying goods received but not invoiced or posted in the purchase ledger to ensure completeness. For example, sometimes we may skip posting some of them. So which process do they do reconciliations of the source documents and the ledger? What do they do to identify them? Then send confirmation letters to the payables, and they should be replying, confirm the balances. You can also reconcile the supplier statements. Supplier statements, they show the outstanding balance. They show amount we have paid and the outstanding balance. Like that. We've already talked about all this. So that is it. Then you must confirm that the trade payables are classified as current in the financial statements as current liabilities. That's an obvious one. Then for these trade payables also, they can also have a debit balance. For example, if you pay a lot of money to a supplier and he must refund it, so you'll have a debit balance in his account as an credit balance. So those are the tests. Confirmation of trade payables, same as confirmation of debtors. You go through this. Then there's a question here which you can look at. We're going to end with this one for today. Audit of payroll, which I've been really talking about in my explanations. So it shouldn't take us a lot of time. For payroll, the documents, it starts with the, for payroll, it starts with the contract, employee contract, which has, this one has all the terms, has all the terms, rates, etc. Then two, after the contract, somebody has gotten a job, he has a contract. The contract has what he must be paid, has the allowances, everything. Then we go to the statutory rates. What is the pay rates, the NSSF rates, you get it. Then we shall have our payroll. Here we have EG. You must not be knowing this. EG, NSSF, AE, LST, log service tax, etc. Payroll will be prepared. Then there are source documents. Like payment voucher, like checks, etc. And then you have the statement of profit or loss, the financial statements. Because this is an expense, but it can also be an accrual. So if it's an expense, it goes to the profit or loss. If it's an accrual, it goes to the balance sheet. Then you also need the GL. Then need the promotions during the year, promotions, transfers. Whenever somebody is promoted, the amount changes. Transfers, demotions. You need terminations. When you terminate somebody, it has an impact at the financials also. etc. So, substantive procedures for payroll. The first one is an inspection. Agree the wages and salaries expense per payrolls to the general ledger accounts. So, payroll, is the payroll agreeing? Is these wages and expense accounts agreeing to the payroll per payroll? So payroll, is payroll agreeing to the general ledger? And then to the financial statement, because from payroll, we have these accounts. There is salaries account for all workers. There can be wages account if there are wages. There's NSSF account. There's payee account. There is LST account. Have the allowances, the separate allowances accounts. etc. So those accounts, that's why I'm saying that agree. You're going to agree the payroll, the general ledger accounts, because there are very many. That's why I call them accounts. They are very many. So these accounts, go to the payroll, look at the total here, total in the payroll. Is it the total in salaries account? This net salaries account, you get it. The total from the payroll, down, if there are 1,000 workers, scroll down and go to the total of net salaries in the payroll. Is it matching with this account? Go to the column of wages, is it matching? Go to the column of NSSF, is it matching? Go to the column of payee from the payroll to the ledger. So these totals should be matching. The total in the payroll should be matching with the total in the ledger. Rollins, please mute. Rollins, mute your mic. So I'm saying that the payroll has totals. Pick the total for each account and match them. Same as payee, same as LST, same as allowances. And also the financial statements. In case there's any differences, you need to verify those, and that will be testing for completeness and accuracy. So that is what I'm talking about. And I hope you've gotten that test. You're getting totals of these items from the payroll, matching with the general ledger and the financials. Investigate any differences, we're testing completeness. Then you recalculate the payroll, the entire payroll, recalculate everything. So this is the recalculation. Get the payroll, Or you can recalculate for a few workers. You select a few workers, look at the contract, how much is he supposed to receive, the basic salary, the allowances, recompute and see whether those figures are correct. You can even put in Excel, get the payroll pasted in Excel or in a software like Caseware or this software. You recompute and see whether it's giving you the, get these payee bands from URA, put yours and see whether you get the same amount. You get it. That is the recalculation of the payroll. You are ensuring accuracy. Then the other test, leavers. We start with leavers, people who left these leavers. Okay, if we start with joiners, get a sample of joiners. When you join a company like today is 2nd August. At the end of the month, they will not give you a salary for the entire month. They must apportion it. So get the list of joiners, check the date when they join, and make sure that their salary is apportioned. They should not get salary for the whole month because they were not there for the whole month. If somebody joined like on 15th in the middle of the month, we only pay him the first salary for 15 days. That's why you're computing that person's salary. For the leaver, check whether he was removed from the payroll when he left that day. So look at his termination letter or the letter that is sending him off. Was that person removed from the payroll? If he's still there yet he left, that's a ghost worker. So check and confirm that leavers have been removed from the payroll. And also their last salary, if they left in the middle of the month, they didn't pay them the entire month. They only paid them for the days they were there. Then also, workers fill in timesheets. Some organizations, they pay you for only the hours you worked. So trace the timesheets that pay to the payroll. Timesheets, if somebody worked for only 10 hours on the timesheet, in the payroll, how many hours have they paid? Get the clock cards, these things of clocking in and out. You can extract when did somebody enter. Like when you're going to start working, when you work for the Indians, every month they go back to the clock-in system. If you came at 10 on a given day, they don't pay you the salary for the whole day. So you depend on the policies of the company. Extract this information and ensure that we're not overpaying workers when they're not working. Same as overtime sheets. For overtime, check that if somebody that overtime sheet, the overtime sheet should be approved by the manager, by the line manager, to confirm that somebody really worked beyond the normal hours, and we only pay him for the time he has overworked. Then for the individual salaries and wages, make sure that they match with the contract. So you're going to compare the contract to the payroll or agree the contract rates to the payroll. But also you can also select a sample of employees from the payroll and check whether they have contracts and the salaries that they're being paid in line with what was agreed upon in the contract. Then also you can recalculate the gross pay and the net pay, confirm that they are correct. You can recalculate the statutory deductions. You can verify existence of employees by doing a head count. You ask all of them to come out and you count them. Or if that one is hard, because you can't tell an MD to come and you count him, you may have to look at their IDs, for example, clock in. Do they clock in every day? Do they sign the arrival book? That would be evidence that they actually work. Do they have performance appraisals and all that? Then you agree the net pay to the EFT schedules. EFT schedules, this is the schedule we prepare and send to the bank to pay workers. We send it to our mother bank, but workers have accounts in different accounts. You will find your mother bank is Stanbic, you the company, but workers have accounts in Orient Bank and Centenary, Stanchart. So you send an EFT to Stanbic, then Stanbic connects with sends money to all the other bank accounts using an EFT, electronic funds transfer. So this EFT schedule, we get it from the payroll, meaning the payroll must be matching with the EFT schedule. So agree that the payroll is physical, then EFT schedule, we fill in the details of these people, sent to the bank. The bank will not give it a physical payroll. we give it an EFT schedule. EFT schedule only put the final pay. So we only extract the net salary from here, from the payroll, put in the EFT schedule, send to the bank, and it's paid. So also, if you are paid by checks, if you don't pay by EFT schedule, you pay by check, you give a worker check. So agree the payroll to the check, to the bank transfer summary, to the cash book, and confirm completeness of the salary paid. Then you can also compare, this is the common test, compare the total expenses for the current year, payroll expense for the current year, the previous year. If there are significant differences, those may show ghost workers. You need to investigate them. You can also compare monthly. I already did this. And then, and all that, yeah. For contingencies, I also looked at it. I at 7, so I'll not repeat it. So we are left with only two items in audit. We're left with audit of non-current liabilities and audit of equity. So we should be able to complete, I think, in the next meeting, if all goes well. So that's where we stop for today. Next time we are starting from audit of non-current liabilities. So in the next class, we may complete, or if we don't complete, we may complete. So we are on the right track. But you guys, you must read. You must read. Auditing requires a lot of reading. So please read your notes and make sure that you understand whatever is in these notes.
Thank you so much for watching. Make sure you subscribe to the channel.